Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Regular viewers will probably notice that I am no longer in New Zealand. I have just arrived back in Asia, a little jet-lagged, but there's a lot to cover, so let's jump in. And first up, multiple European outlets are now reporting that the United States is preparing to push its G7 allies to impose steep, and I mean very steep, tariffs on India and, more notably, China for continuing to buy Russian oil, a move Washington hopes will force Moscow to the negotiating table over Ukraine, but which would infuriate China. According to four people briefed on the plan, speaking to UK-based The Financial Times, for example, the proposal will be a central item on the agenda of a G7 finance ministers' video call on Friday. Today. The initiative is the latest step in President Donald Trump's drive to broker what he has branded a peace and prosperity deal to end the war. Earlier this week, he urged the European Union to levy tariffs of up to 100% on Chinese and Indian goods. China is especially vulnerable, relying heavily on exports for growth. Regular viewers of my other channel, China Update, will know that exports represent one of the few bright spots in Chinese economic data. And with what looks to be a $1 trillion surplus this year, a lot is riding on that continuing. Washington has already raised tariffs on Indian imports to 50% and imposed steep duties on Chinese goods in April, though some of those were later rolled back after a sharp market reaction. Quote, Chinese and Indian purchases of Russian oil are funding Putin's war machine and prolonging the senseless killing of the Ukrainian people, end quote, a US Treasury spokesperson said, adding, quote, if our EU allies are serious about ending the war in their own backyard, they will need to join us and impose meaningful tariffs that will be rescinded the day the war ends. End quote. People familiar with the discussion, speaking to UK-based Reuters, said Washington is pushing for tariffs between 50 and 100%. But the proposal faces stiff resistance in Europe, where officials warn that such measures could trigger retaliation from Beijing and undermine trade talks with India that Brussels is hoping to finalize within weeks. Instead, the EU has floated alternatives such as accelerating its planned 2027 cutoff for Russian oil and gas imports and tightening sanctions on Russian energy producers. Such measures, however, would require consensus within the bloc, which has often been hampered by opposition from pro-Russian governments in Hungary and Slovakia. Both countries continue to import Russian oil via pipeline and have blocked tougher EU sanctions in the past. Energy security remains a pressing concern for Europe despite progress in reducing reliance on Moscow. The EU still sources roughly 20% of its gas from Russia, down from nearly half before the invasion in 2022. EU Energy Commissioner Dan Jorgensen met with US Energy Secretary Chris Wright on yesterday, to discuss boosting shipments of American liquefied natural gas. Quote, we need as fast as possible to get rid of the dependency that we still have on Russian energy, end quote, he said. Canada, which holds the rotating G7 presidency, confirmed that it convened Friday's meeting, quote, following discussions with the US, end quote. Ottawa said ministers will debate, quote, further measures to increase pressure on Russia and limit new war machinery, end quote. But Canada also faces its own diplomatic balancing act, having recently sought to repair relations with both India and China as part of its push to diversify trade beyond the US. And speaking of the US, that brings us nicely to North America. Goldman Sachs has warned that gold bullion could soar to nearly $5,000 an ounce if the Federal Reserve's independence is compromised and investors shift even a fraction of their Treasury holdings into gold. In a note to clients, analysts led by Samantha Dart said a weakened Fed could risk fueling inflation, depressing stock and bond prices, and undermining the dollar's role as the world's reserve currency. In contrast, gold's appeal lies in its status as a store of value independent of institutional trust. The bank outlined a bullish trajectory for the metal, a baseline target of $4,000 an ounce by mid-2026, a tail risk scenario of $4,500 and close to $5,000 if just 1% of privately held US treasuries were redirected into bullion. Gold has already been one of 2025's top performing commodities, rising more than a third this year and hitting a record of above $3,578 this week. Gold has eclipsed its inflation-adjusted peak set more than 45 years ago. Central bank purchases, expectations of Fed rate cuts, and political uncertainty around US President Donald Trump's moves to exert influence over the Fed have added momentum. Meanwhile, while we're still in the US, applications for US unemployment benefits jumped last week to their highest level since October 2021, signaling potential stress in the labour market amid slowing hiring. Initial jobless claims rose by 27,000 to 263,000 in the week ending September 6th, well above economists' expectations of 235,000, according to Labour Department data released yesterday, Thursday. The increase follows a weak August jobs report, which showed the economy added just 22,000 positions, extending a months-long slowdown in employment growth. Economists point to mounting uncertainties surrounding the administration's economic agenda in 2025 as a key factor weighing on employer confidence. Some commentators have pushed back, simply saying that the economy is going through a transition and so short-term disruption is to be expected. Continuing claims, which reflect the number of Americans already receiving unemployment benefits, held steady at 1.94 million. Economists noted that while the sharp rise in Texas drove last week's figures, a broader nationwide increase would have been more troubling. The report comes just days before the Federal Reserve's September 16th through 17th policy meeting. This is next week. With job growth stalling and unemployment claims climbing, analysts expect the Fed to resume interest rate cuts after months of holding steady to contain inflation. Meanwhile, core consumer prices rose 0.3% in August, matching forecasts. Now, next up, we need to move to Asia, but just quickly, if you're getting some value from today's episode, don't forget to hit the like button, and if you'd like to continue to be on top of the most up-to-date analysis on the world's most important markets, consider subscribing to Market Update, hit the bell notification icon, and you will be. And finally, for today, we move to Asia. South Korean equities surged to new heights on Thursday, yesterday, with the benchmark Kospi index closing at a record high after President Lee signaled he would not push ahead with a controversial capital gains tax increase. The announcement lifted investor sentiment in Asia's best-performing market of the year, even as diplomatic strains with the United States cast a shadow over the country's investment outlook. The Kospi climbed 0.9%, surpassing the previous day's record and extending a rally that has seen the index gain more than 38% year-to-date. Markets in Japan and Taiwan also remain buoyant, boosted by renewed enthusiasm for artificial intelligence technologies and the strength of regional chip makers. Lee, who took office in June, has pledged to channel capital away from South Korea's overheated property sector into equities. His decision to leave the capital gains tax proposal in the hands of legislators eased concerns that higher taxes would deter investment. Quote, "This controversy felt like a test for my determination to revive the stock market," end quote, Lee said, adding, quote, "If so, I wonder if we should stick to the proposed change," end quote. South Korea's equities have long traded at what analysts call a Korea discount, reflecting concerns about corporate governance, family-dominated conglomerates, and low dividend payouts. Lee's government has moved to address these issues, continuing reforms launched under his predecessor, Yoon Suk-yeol. In July, Seoul amended its commercial code to strengthen directors' obligations to shareholders, drawing comparisons to Japan's shareholder-friendly reforms. Quote, "We've seen some very progressive regulation being passed by the new government in Korea, reflected perhaps also in the performance of the Kospi," end quote, said Helena Thong of Asian Corporate Governance Association. Lee has also suggested cutting dividend taxes to incentivize payouts and attract household capital into stocks. Quote, "If it doesn't dent our tax revenues much, our goal should be to pay dividends as much as possible," end quote, he said. Currently, South Korea's annualized 10-year total shareholder return stands at just 5%, well below Japan's 7.7% and the US's 12.3%, according to MSCI data. The optimism in Seoul's markets is tempered by fallout from an unprecedented US immigration raid, which we've been covering here on Market Update. A Korean Airlines charter flight carrying 330 people, including 316 South Korean nationals, left Atlanta on Thursday, yesterday, repatriating workers detained in a September 4th sweep of a Hyundai LG battery plant in Georgia. Images of shackled Korean workers sparked outrage in Seoul, dealing an early blow to Lee's presidency. The Hyundai CEO said the raid would delay construction on a multi-billion-dollar plant by several months. This incident comes just weeks after Lee's summit with US President Donald Trump, where the two leaders sought to reaffirm economic and security ties. Lee warned the crackdown could deter future Korean investment in the US. The raid also compounds existing trade tensions. A July agreement preserved a 15% tariff on most Korean imports, and Trump has yet to sign an order lowering auto levies. Meanwhile, the two sides remain at odds over Seoul's $350 billion investment pledge. Commerce Secretary Howard Lutnick said Thursday that South Korea Korea must honor the deal or face tariffs, though he added that Washington would facilitate short-term visas for skilled foreign workers. For now, investor optimism over Lee's market-friendly policies have lifted the Kospi to historic highs, but the immigration dispute underscores the fragility of South Korea's external environment, an external environment in which it is very reliant on the US market. The country's challenge will be to sustain its market momentum while navigating turbulent trade relations with its most important ally. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Friday, have a good weekend, a restful weekend, and I will see you for a new week of updates on Monday.